This series of the 2025 50 Faces podcast is supported by Eagle Point Credit Management. Eagle Point Credit Management is a specialist investment manager principally focused on income-oriented credit investments in niche and inefficient markets. Currently, they believe that Eagle Point is the largest investor in CLO equity in the world and one of the largest non-bank lenders focusing on providing financing solutions to credit funds. This series is supported by Benefit Street Partners. Benefit Street Partners is a leading global alternative credit asset manager offering clients investment solutions across a broad range of complementary credit strategies, including direct lending, special situations, structured credit, high-yield bonds, leveraged loans, and commercial real estate debt and equity. As of December 31st, 2024, BSP Alcentra had $77 billion of assets under management. Our next guest began his investment career by pitching stock ideas to one of the hedge fund greats. Hear from him how he segued into public pension funds and how now, as CIO at the Chicago Teachers Pension Fund, he brings his air of calm and perspective to the complex world of investing. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Fernando Vinzons, who is Chief Investment Officer at the Chicago Teachers Pension Fund, a role he has held for almost 3 years. He previously spent over 13 years at the Cook County Pension Fund and started his career in investment research. Welcome, Fernando. Thanks for joining me today.
Thanks for having me, Ethan. I'm excited to be here.
Well, let's start by talking about your background and how you ended up pursuing a role in the investment world. Can you take us right back to where you were brought up and what you studied?
I'm a Chicago native, but wasn't born here, but I've been here most of my life. So all my schooling has been predominantly in the Chicago area. I went down to University of Illinois, Urbana-Champaign for undergraduate studies, and then I finished my MBA at the University of Chicago. I'm a North Sider, so I grew up in Roscoe Village, just 2 miles west of Wrigley Field. So I've got deep Cubby blue in my veins in terms of sports backgrounds. But in terms of actual, how I got started in the investment world goes back to right after business school. I entered investment banking. I was in New York for about 2 years at Payne Weber. But New York, I think I was allergic to New York, so I wanted to get back to Chicago. So quickly hightailed it out of there along with the high rents and settled back into Chicago. And then I took on a role with a startup company that was funded by Michael Milken. This was back in the early 2000s, and it was an online education company. And I think he put in like maybe $150 million into this company. But what was missing at the time were fast internet, the ubiquity of cell phones and what the cell phones can do today. So while we were building great courses, the ability to deliver on that, I think, was just a little bit short in terms of the vision. So that didn't last very long, and it soon followed with a stint for a couple of years. I think it was about 4 or 5 years where I joined Driehaus Capital Management, and I was an equity research analyst there. I was picking and choosing stocks for both the small and mid-cap funds. At the time, Richard Driehaus was still alive. It was really exciting to pitch stocks to the man himself, a local Chicago celebrity. So a couple of years of that, and then I happened into a job posting at the University of Chicago's Booth School of Business job posting board for an entry position with a pension plan. And, I didn't really know what pension investing was all about. But yeah, I was with Cook County from 2009 till 2022.
Fantastic. Well, lots to follow up on there. It's hard to know where to begin, really. I suppose startup world and pitching stocks to one of the greats. Any lessons learned that you took into your allocator role, which has taken up the best part of the last decade and a bit?
I think it was really good that I had that background with Driehaus because in terms of being able to speak stocks, that's where I'm most comfortable. In terms of lessons, at Driehaus, you really had to just get in the mix. The way we analyze and pick stocks was whatever was moving that day, you were expected in about half an hour to have an opinion, whether it's a buy, sell, or hold. So you had to move quick. You had to have a really good understanding of the stocks in your coverage group. And you had to, again, have an opinion on the spot if someone asked you, what are we doing with this stock? So I learned to think quick on my feet and be able to just say, hey, I'm taking a stand on this. And you learn to do that just by practice and honing. And also when you know your companies well enough after several cycles of reporting, the way I described it was, pattern recognition. After a while, you got a sense of what companies were doing to a certain extent, and you got to know them. And based on that, you formed your opinion.
And then the public fund world, you've clearly found your way into that. How have you, I suppose, what's different about the public fund world to some of those other worlds you started in?
Yeah, whereas being in the mix directly with fund investing, I think with public pension plans, you're one step removed, especially with the way we do it here in some of the smaller plans where you actually hire the managers. We didn't run our own book. So you then relied on the manager. So to a certain extent, I did apply the kind of pattern recognition. You got a sense for after working with managers what they were good at, what they were a little bit maybe deficient on. And using that knowledge allowed me to better navigate the pool of managers that we invested with. I will say that when I started in public pension plan investing, I couldn't tell you the difference between a private equity fund and a hedge fund. It took me several years to finally, understand what that was all about because I was just so focused on the public side of investments that I really don't know anything about the alternative side of the world.
It's certainly a learning curve that is steep and can be long, but certainly changing as we go. And I'd love to now go to Chicago Teachers Pension Fund. So 4 years ago, we spoke with Angela Miller-May, who was then CIO at the Chicago Teachers Pension Fund. I'd love if you could bring us up to date in terms of setting the scene for the fund, the size, its funding level, its asset mix and governance.
Yeah. So the Chicago Teachers Pension Fund currently, it's March 14th. It's about 12.5 billion. We are serving over 90,000 members. Similar to Cook County, we don't run our own book. We're very much reliant on the expertise of external investment managers. It's a very diversified portfolio. We have a little over 30% in domestic equity. We have about 25% in international equity, a little over 18% in fixed income, and then the remainder in alternatives. And within alternatives, we have almost 10% in real estate, 8.5% in private equity, and 2.3% in infrastructure. And the remainder is in cash. And we are embarking on 3% virgin allocation to private credit. We're starting to deploy capital for that, but it's early days, but we're looking to build up to that 3% target allocation. So in terms of governance, we have a 12-member board. 6 are active teachers. 3 are retirees. 2 are from the Chicago Public Schools Board, appointed by the mayor, and 1 represents the administrators and principals that work within the Chicago Public School system.
And if I recall correctly, that's quite a vocal and active board. They meet the managers. There used to be at least once a month a kind of an open mic, almost like a manager Friday, manager introduction. Is that still how the board interacts?
Yeah, for the most part. What we have done is we've slightly curtailed the frequency. The first Fridays are now what we call first look because we've moved it out of Fridays. They're mostly on Tuesdays. And we run them about 6 times a year, whereas before I think they used to do them every month. So there was just a more heightened cadence to it. But, really the purpose of that program is to allow smaller firms such as MWBE firms. And really at inception, the goal was to tailor it for MWBE firms, give them access directly to the board, to the consultant, to investment staff, unlike ever before, because I think the past criticism was it was tough to get through some of the gatekeepers, the typical gatekeepers in the industry. And so this allowed funds to go direct to our board. Now, they didn't always necessarily, the goal was not to award mandates there on the spot, but to give them really some practice time with answering questions from a board of trustees or an investment committee. And also from our standpoint, get to know some of the smaller firms that are out there and maybe find future talent that we could grow with. as they become more successful.
We're going to take a short break to hear from one of our sponsors of this series, Eagle Point Credit Management. I sat down with Tom Majewski, founder and managing partner of Eagle Point. I asked him if he could give us a snapshot of the current state of the private credit industry.
Definitely a maturing market would be the first thing I would say. Private credit assets in general are held in very stable or sticky hands. Anytime you hear multiple trillions of dollars in something new, you've got to ask the question, and that's a very fair question to ask. Often what makes bubbles burst is when they're held in short-term hands or unstable hands. And even if my prediction is right that perhaps there will be some defaults in the private credit world, I still think most investors will have a positive return, but maybe not as positive as they were expecting.
And now back to the show. Besides the private credit initiative, anything else at the forefront of your mind today in terms of the current landscape that you think, where will you be looking to next? Are you making any changes to your asset allocation?
So just to step back a little bit, I started with Chicago Teachers in the middle of 2022. And as you know, the market was pretty tough then. And I came in, really spent the first 6 months kind of just getting acclimated. And then in 2023, got right down to business and tasked our investment consultant, which is Callan, to relook at the target allocation to make sure that it still made sense given the environment that we were about to go into, which was rising interest rates, and also how international had lagged the US for so long, and at the same time also value lagging growth. So we made a lot of adjustments, but primarily we used to be equal weighted domestic to international. So we've reduced that to more of a kind of 60-40 balance. And also the fact that we were over allocated to alternatives due to the denominator effect and the fact that private equity, that valuation wasn't going to go down over time because we were still continuing to deploy. We had to be aware of that and adjust that within the allocation, but still somehow find some way to allocate to new areas such as private credit. So all that factored into the new target allocation, which is 30% domestic equity, about 20% international. And then fixed income, we took it from about 18% to 24%. And then the rest stayed the same, plus that new private credit allocation. So that's the new target allocation. And then last year, 2024, most of our activity was spent running searches to try and, again, account for all the new buckets that we've identified and all the movement. And so far this year, the goal is to implement, really to rebalance. We were hoping to do that end of last year. That would have been a great time, but here we are, and we'll do the best we can given the environment that we're presented with. But yeah, I think this year will be more of an implementation year.
And speaking of the environment, MWBE efforts, Angela spoke in detail about that, and CTPF has had a long history of not just words, but action in that respect. And I think it has really shown the way to many other public plans. You spoke about your first look being designed to assist some of those funds get out of the gates. Can you talk about your commitment in that area now?
Well, I can't take credit for majority of it. Again, I've only been on for a little bit under 3 years. So it's been the effort of past other boards, CIOs, and executive directors. But where we stand today, over 51% of our portfolio is allocated or managed by MWBE firms. And we're really proud of that. And I think we will continue to march down that path. We, again, as I mentioned, we have this first look program, and it allows us to get a preview of future firms that are going to be successful, whatever asset class they may be in. That's the future. We're always looking for new talent, but diversity is definitely very much in our DNA, and we will continue to pursue it as long as the board gives me as long as those are their marching orders, we will pursue it, and it clearly aligns with our value.
I suppose it's one thing to have a mission and a purpose with that in mind, but actually implementation can be challenging. How do you ensure that you're scouring the landscape? You mentioned the first look. And I suppose, what are you hearing from these managers about whether your peers are doing the same thing? Is it easy, or as hard as ever to get attention?
Yeah, I think they share the same challenges that other firms that are not MWBE, if they're just getting started and maybe they have a great track record and a great background, but may not have as big of a Rolodex as some of the other firms that come out of the starting gate with, 1 billion allocation right away from a parent company that's they're spinning out of. So I totally understand that. So I think the challenges are the same as they've always been. And the analogy that I like to share with people, because I think Illinois is so renowned as well as New York for working with MWBE firms. And so we become almost like a first stop. But the challenge is in Illinois is a lot of the plans are underfunded. And so that underfunded situation keeps us to a certain extent below a certain percentage in terms of, let's just say, alternatives, because there's a lot of new firms in the alternative space that are being accepted. And so the checks that we write are just a lot smaller these days. And again, it doesn't help that we're over allocated. So the analogy I like to say is like everyone knows it's like Halloween. The neighborhood that you're in gives out candy and you're going to get candy, but it's not the big candy that some of the rich suburbs give out, right? These are in the suburbs, they're full bars and they can't give them away fast enough and no one's going to them. I'm not saying it's that way, but there are plans that are giving away big bars because they have money to deploy. So some of the states that are almost like sovereigns by their nature that are generating $1 billion, just from leases out of the ground, they don't know what to do with it. To me, that seems like fertile field for firms who are looking to grow their business. That would be a great place for them to start. But I realize it's a challenge and you got to start somewhere. And if we can be supportive and helpful in getting traction by getting their first few dollars, we certainly would like to be helpful from that standpoint.
We're going to take a short break to hear from one of the sponsors of this series, Benefit Street Partners. I sat down with Rich Byrne, President and CEO of Benefit Street Partners, and asked him about the importance of hiring for cognitive diversity within the firm.
I think it's great when people have varied interests. It's just not that interesting to see somebody who was a business undergraduate and business school graduate major and then went into investment banking and, sometimes become somewhat one-dimensional. So the ability, and remember, everything we do in probably in the entire work world, but certainly in the Wall Street workspace, is there's a sales component. You're interacting with other people, whether they're clients or your internal constituents. And I just think it makes you more relatable, more human, more interesting to have varied interests.
And now back to the show. Pulling the lens back to the industry as a whole, I know that you've been involved with Tide and a number of other groups that are assisting with not only these firms, but also just generally furthering diversity of the industry. Any comment on the grade you'd give it, how far it's come? You've been in it most of your career.
In terms of a grade, I'll be a little bit more generous and maybe give it a B minus. I just think that there's a lot of room for potential. There are asset classes that are probably further along than other asset classes. Like, for instance, I think real estate, there's still a ways to go. It's just that asset class to me is a little bit more, for lack of a better description, more old fashioned. And it's just the way it's come along. Whereas private equity and private credit, they're more recent in terms of the sub strategies. And so people can spin out of firms and quickly establish themselves. Whereas in real estate, those old relationships still have a bearing on your ability to transact, right? And so we've seen less diversity in some of the more traditional asset classes like real estate. But, again, I'd love to be proven wrong. I'd love, people who are listening who have not heard of Chicago Teachers First Look, feel free to reach out to me so that we can get you in front of our trustees and hope to see more diversity in the alternative asset classes.
Well, that is a generous invitation. Thank you. I'll be sure to note that as well in the show notes. And just going back to some personal reflections now. So we started with your journey into finance, from investment banking into startup land, into pitching stocks to one of the legendary stock pickers. Any setbacks or challenges over the course of that journey that you learned lessons from?
There's several. The biggest thing, and even my experience at Cook County, it's easy to want to chase after the returns when, you have these great investor relations folks and marketers who come in with great track records, right? But but you have to be able to cut through a lot of the marketing to distill and hone and identify what are the return drivers that will make it sustainable. I've certainly had my share of, you get wowed by the returns you get in, and as soon as we get in, it's like, wait, what happened? And you wonder to yourself whether you made the right decision, because it just, after that, they've just underperformed. So I try to look beyond the returns and really try to nail it down to see if it's something that was a flash in the pan or really has legs for long term. Another lesson probably is just not being too worried about the short term. I've gotten my share of calls over the past few days, like, what do I do? What are you guys doing at the pension plan? I said, listen, by virtue of our size, we just don't trade our portfolio the way you would want to do it on your personal portfolio. And again, if your day job is not in the investment industry, don't make it so by trading your PA, your personal account. You're just going to keep yourself awake. So I've certainly had to talk some people off the ledge these past couple of days. And then also just helping along with that, I think helping people focus more on the bigger picture. If your goal is to grow assets, I think especially when I've had to train people, it's good that they're focused on the details, but also trying to help them make sure that they stay on the path and realizing what the bigger goal is and not get mired in the nitty gritty. And then I'd say the final lesson something that I've just learned just over these past few years, just the adage is, consultants usually will recommend the big name firms because they can't get in trouble for that, right? But what I've noticed is you can get in trouble because the bigger they are, the harder they fall. And so perfect example in real estate, I think some of the core funds where you get in, they got big, and then, you have a downturn like we experienced in commercial real estate, and you're stuck, right? They've got huge queues, whereas some of the smaller firms may not have had the same issue of having to deploy large assets, and they were much more selective, and so didn't get us caught in those kind of, I don't want to call them stranded assets at this point, but they certainly are starting to feel like it, right? With ideas, very few ideas on how to turn some of those assets around.
Really interesting. And just in terms of trends, you mentioned using external managers. Steve Neal from New Mexico Public Pensions was on this podcast at the beginning of the year, and he spoke about how they partner with managers in strategic partnerships. Do you see that as being a direction of travel that Chicago teachers will take?
Again, we'll partner with them. We don't take on direct investments. In fact, even like co-investments, we do very little of it. We really rely on our partners. I don't see that changing anytime soon.
Fantastic. And now moving to the mentor section. I know that you've spoken about some of the individuals you worked with throughout your career. Was there any key person there, a mentor to you, or a sponsor, or anybody that had a particular influence on your career path?
I think it was certainly helpful that the CIO at Kokani at the time, I don't know if you've interviewed Nicole Hackett already, but Nicole, who's over at the Joyce Foundation, she's the CIO and CFO. I think the way she told it to me, and she's not one to embellish too many things, she told me that I beat 100 other resumes when she was looking for her first hire and only hire at the time. So that was, to me, a key moment in my career. And so I made the most of it, learning from her, and also the situation in that it really was just the two of us trying to turn around what at the time we thought not very institutional quality in terms of the underlying investments and managers that we had in our portfolio. And so we set to work on trying to make it more institutional quality and learned a lot from that. But along the way, there have certainly been very, I'd say, supportive trustees, individual trustees, even past executive directors were great to work with. And I'm lucky that I think I've got a network of family and personal friends who keep me grounded. And then also on a more kind of day-to-day basis professionally, I have a network of friends in the industry who provide guidance and advice. So they've all been very helpful. And as well, friends that I've picked up along the way, just being in the pension plan world.
And my last question is around any words of wisdom. So just wondering if you have any words of wisdom to leave us with, whether a creed or motto you live by or advice you might have for your younger self.
Yeah, I mean, a couple. I would say these days, as I get older, I always have to remind myself, you've got one life to live. How do you really want to live it, right? So in terms of, again, when people walk through my door and have these issues, for them, it's issues. To me, I said, these are matters for the day. Think about it. You have your life outside of work. Do you really want to bring this home with you? So that's how I like to frame things, because again, they may be huge things, but in the whole scheme of things, it should not be the things that you want to define your life by, or at least stress your life with. So I try not to let it stress myself and let them stress it. So, I try to be more, let's just figure out the best solution and not let it, again, erase minutes, months, years off our lives, right? And in terms of advice for my younger self, I would say, if I were to go back, I would say, listen, you got to travel more. It's not just because it's fun, but what I've learned is it can really provide better perspective when you see the greater world out there. And that's what I think I've taken away from the travels. Just whether it's Asia or Europe, you just have a better understanding. So yeah, perspective.
Well, very appropriate that you ended on a note of education, given we're discussing the Chicago Teachers Pension Fund and clearly massively important constituents that you serve there. And I think what has come across for me throughout this is exactly as I expected. You do emanate a great sense of chill and calm. And I think given the high stakes environment in which you work, that's probably more important than ever. We know it's not easy in the public fund arena. We know that funding levels are not what they should be. And we know that there are challenges, but I think to have your perspective is a real asset to them. So thank you so much, Fernando, for coming here and sharing your insights with us.
Thank you for having me, Ethan. This was a wonderful time spent.
I'm Ethan Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. You can find all of our content on 50 Faces Hub, where you'll find a library of role models, resources, and other solutions to enhance your career. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.